Exercise 9-18. Once again, we're going to use the allowance method to calculate uncollectibles, but this time we're going to use, instead of percentage of sales, we're going to use percentage of accounts receivable. So this problem is the exact same as the previous problem, 9-17, except we're not going to use the percentage of sales, we're going to use the percentage of accounts receivable to calculate how much of AR will not be collected. So let's start off with the same transactions. We need to journalize Hilly's transactions that occurred during 2016. The company used the allowance method. So they had sales of $174,000, of which $157,000 were on account. So we got AR of $157,000. We've got cash sales of $17,000. And then we have total sales revenue of $174,000. So we recorded the sales for the year, and we're going to ignore cost of goods sold just to keep things simple. And then later they've collected on account $131,000. So cash is going up, and accounts receivable is going down because we've collected that amount. And these are our collections. Now we're going to write off our uncollectible receivables, $2,200. So what's going on here, once again, I'll explain this transaction. We've deemed that $2,200 of our accounts receivable will never be collected. So we have to get that AR off of our books. So I'm going to lower AR with a credit. And let's get back to the definition of allowance for bad debts account. This is, and in this problem, we've got $3,000 in the account. In other words, we think $3,000 of our AR will not be collected. But we decrease this account whenever a customer, we have deemed a customer as not going to pay us ever. So this account is being lowered because the account is no longer doubtful. It is now definitely uncollectible. So that's why we're lowering this account. We wrote off uncollectible accounts. Now, a lot of students want to use bad debts expense here, but we can't because we do that at the end of the year. Now, enter the beginning balances and journal entries. So we're posting the transactions to AR and the allowance for bad debts T account. And we're going to start with the beginning balances. So beginning balances of AR is $31,000. And the beginning balance for bad debts, or for the allowance account, was $3,000. And then we're just going to go up here to our journal, and we're going to, first of all, post to AR. So let's find our first transaction with AR. We've got $157,000 on the left side, and those were our sales on account. In other words, called credit sales. Let's see what else we've got. We've taken care of this AR. We've got another AR, $131,000 on the right side, because we've collected that amount. So we've taken care of this AR, and then we have AR going down because these accounts we think are uncollectible. $2,200 uncollectible. That's called a write-off. We wrote them off. And then we need to post to the allowance account. So we're going to go up here, look for allowance. Nothing there, nothing there. Here's our allowance. We got $2,200 on the left side as write-offs. Now we need to do the balance. So let's do the balance of this one first. We got $3,000 on the right side, $2,200, so we have an $800 unadjusted balance. This is unadjusted because we're going to be doing the adjustment right after this. And for AR, we're going to take $31,000 plus $157,000 because this is the plus side. We're going to subtract $131,000 to subtract $2,200, and that gives us a $54,800 unadjusted balance. So at this point in time, we have $54,800 owed to us from customers, and we think about $800 of it will not be collected. But we've got new information, so we're going to have to adjust that $800. Now we get to the new part, what sets this exercise 9-18 apart from the previous one, 9-17. We're going to journalize Hilly's adjustment to record bad debts expense, assuming Hilly estimates bad debts at 3% of AR. So what is the balance of AR at this point? It's $54,800. So the company thinks 3% of that is not collectible. So we need to calculate this. We've got 54,800 times 0.03 gives us 1644. Okay, now this is the part that sets it apart from 9-17. This amount here, 1640, is the total amount that should be an allowance for bad debts. We've already got 800 in it. So how do we go from 800 to a new total of 1644? We're going to add 844 more to that. So this credit will be the allowance account. So once we post this, allowance will have 844 plus 800 gives us the 1644. And then the other account is the bad debts expense. Now, some students get confused about why this 1644 is the final number for this, and why we do not just add it on to the unadjusted balance. Well, let's make this simple. Let's say our AR was 0. In other words, no one owes us anything. So what should the allowance for bad debts account be? It should be a total of 0. So in other words, if we had 0 AR over here, this would also have to be 0. So we would have to lower this account so that its final balance is 0. Why? Because if we had 0 AR, then it's impossible for any of it to be doubtful because there isn't any. So that's why this 1644 is going to be the final number for the allowance. We're not just going to add up the 800. So each year we have to redo the balance. So in this case, we think the balance should be 1644. So to make this balance 1644, we're going to have to add 844 to it. Recorded bad debts expense for the period. Now, post the adjustments to the appropriate T accounts. First, enter the beginning balance of the bad debt expense. And then remember, enter a 0 on the normal side for any account with a 0 balance. First, enter the beginning balance of the bad debt expense account. So at the beginning of the year, how much do expenses have in them? Well, expenses are always clear or closed at the end of the previous year. So on January 1st, they start with a balance of 0. And notice this says first enter the beginning balance. So beginning balance of bad debts expense is 0. Now it says post the adjustment through the appropriate T accounts. So this is our adjustment right here. Notice it says journalize Hilly's adjustment. So we've got a bad debts expense on the left side, 844. So I'm going to post that there. You scroll up so you see kind of where the number came from here down to bad debts expense. That's our adjustment. And then we'll scroll back up, and now I need to post this 844 here. This is our adjustment. And now we need to do the total. So we had 800 unadjusted balance, add 844, and this is where we get the 1644. So this is our new December 31st balance. And our balance of AR is still going to be 54,800 because we did not adjust it. So what this means is our customers owe us 54,800, and we think about 1,644 of it, in other words, 3% of this 54,800 will not be collected. Why did we use 3%? Because this company, in their history, they found about 3% of their AR balance is not paid back. Now we need to figure out the balance for our bad debts, 844, and that's our December 31st balance. Now the last thing we need to do, it says show how Healy Mountain Flagpoles will report the AR on its December 31st balance sheet. So we're going to show our gross AR, 54,800. And then we're going to subtract our bad debts, allowance for bad debts, 1,644. And that gives us a balance, also called the net realizable value, of 53,156. 53,156. So what this means is that our gross AR is 54,800. Well, that's not the important number. The important number is how much do we think we will actually collect of the 54,800? The amount we think we will actually collect is 53,156 because we think 3% of it, in other words, 1,644, will not be collected. And that's it.